All right, there we go. Hey, everyone. Everyone, welcome. My name is Darren Shepherd, Shepherd Real Estate Team. Team wants to welcome you guys and thank you guys for coming in and learning about real estate and learning some about the changes that have happened, positive changes, and how that can impact your family. And so you're able to position yourself. And so one of the things we were talking amongst ourselves, and we get so many questions from different clients about whether they're upsizing into a larger home, downsizing, buying an investment property, moving out of state. And so what we want to do is create a series. And so this is a kickoff to a monthly series that we'll be answering big real estate questions, small real estate questions, connecting with policymakers as well, hopefully in our local markets about just what's going on, good changes, bad changes. So you guys have a much enough cutting edge information to make educated decisions and plan long term. Obviously, we all know that we live in a great state, but it's also an expensive state with a lot of different policy changes on a seems like a daily basis. And so we want to be that kind of mouthpiece for you guys to filter that information to you, so you again can make decisions and not just be overwhelmed with all the information that's out there. Want to welcome the team as well. You got Jerry here that you guys a lot know, and Nick and Melissa and Dakota that's in the background running and handling everything in the background. And so another thing that's really important with us is we talk with a lot of smart people. For us personally, so we're able to position our clients to succeed. And so that's another thing, is that we're going to bring those smart people that specialize in taxes, or whether it's loan officers that are dealing with clients in different situations on a daily basis, and bring those people into your community so you feel empowered to reach out to them when you have a question, just like we reach out to them on a daily basis, again, with our clients and or personal questions, so we're able to position ourselves and our clients to succeed and whatever plans they have coming down the pipeline. So Byron should be on here right now. He's going to take control and really dig through, come up with some different scenarios and dig through how some of these changes and what they are, and how you can position yourself, and if they impact you or don't impact you, or could impact you in the future in a positive way, so you're able to position and plan for your family. So Byron, go ahead and take it from here, man.
Hey everybody, so this is Dakota here. Byron's he's having some technical difficulties. He's going to join on in just a moment here. But while we're waiting for Byron to join on, yeah, we just want to welcome everybody here. I'm going to make sure everything's running. Darren, is there any preliminary questions that we can answer regarding results, or any little snippets that we can give everyone?
Yeah, so the majority of people that are joining, some might be driving home from work, and so, or not in front of a computer on their cell phone, and they're just muting themselves and listen to it like it's a podcast. So if you do have questions towards the end, you can just put them in the chat box, and we can dig into your questions towards the end, and or we're gonna send out a recording of this with a transcript of it as well, so you guys can listen to it at a different time or share it with friends and family. And you can able to set up an appointment with myself or Jerry or Nick or Melissa, and dig into your situation, and Byron to dig in to your particular situation more, so you don't have to share your income and any private details if you don't want to share those things. But again, if you have general questions, you can just put them in the chat box, and Dakota will read those out, and then we'll go ahead and dig into that. Let's see here. There, and someone removed. Dakota, are you looking at Byron's thing?
I am right now. One second, guys.
Hey, real quick, Darren, I'm just really excited just to be a part of this whole thing. I know there's a lot that goes into it, and cannot wait for the rest of the whole series that's coming out as well.
Yeah, we have many different subjects that we're talking about. Some to tease, as we have, they're making big changes in Dana Point Harbor, so we're trying to connect with someone, and there's a lot of rumors out there, really connect with someone of actually what's happening, what restaurants are going in there, how that's going to impact people again in a positive way, and values. We talking to people in Huntington Beach and Mission Viejo and San Clemente, and just really, again, digging into specifically what's going on. But yeah, we're really excited to dig into that. So it looks like we have Byron.
Hey everyone, how's everyone doing? Sorry, a little late.
No problem.
All right, you guys. So I'm not sure how much of this Darren went over ahead of time, but wanted to just get on here and explain kind of some of the changes that have gone on recently due to the One Big Beautiful Bill. Essentially, what it's done is change the caps or the maximum amount you can deduct to SALT. I think that this topic can be a little bit complicated because there's a lot that goes into tax deductions when it comes to owning real estate. So for this meeting, I'm going to try to get into as much of it as I can. And first, just kind of explain what is SALT, right? So SALT literally stands for state and local tax. And SALT is just a group of deductions that you can take when you're itemizing your deductions. Okay, so if you look here, right now, when you guys are filing your deductions, you can do either a standard deduction, which is a flat amount that the IRS allows everyone to take, or you can itemize your deductions instead, right? So you can deduct certain things like mortgage interest and property taxes and state income tax. And in Orange County, most homeowners actually itemize their deductions, while nearly all renters take the standard deduction. So if you look here, this is actually a Form 1040 that you guys complete every year when you do your taxes. Most of you either have an accountant that does it, or you use like something like TurboTax, and where you put the information in, then it automatically populates this stuff. The thing I really want to point out here is that you'll notice on line 12 that you have the option here when you're doing your taxes, because you put your income here on line 1, and then at the end, line 12, you can deduct a certain amount, right? So the IRS allows everybody to take the standard deduction, whether or not they own a property. And that amount is listed here on the left, depending on your situation, right? So if you're a single person, you're able to deduct $14,600 as of 2024 from your income, and then pay taxes on whatever's remaining, right? If you're married, filing jointly, you can deduct $29,200 automatically. If you're head of household, you can deduct $21,900. Now, most people, again, if they're not homeowners, they're taking the standard deduction. And even if they are homeowners in some parts of the country, they're taking the standard deduction because the amount of things they can itemize don't eclipse this amount, okay? So for most people in Orange County, though, they can itemize their deductions instead. All right, so what does that mean? Well, actually, first, the thing to note is that these numbers here were for 2024, but they are changing, right? So the standard deduction goes up a little bit each year to keep up with inflation. And for 2025 and 2026, these are going to be the standard deductions. And as a reminder, I'm sure Darren's going to send this this deck out to everybody on this call, so you guys can have a copy of this, so you can keep track of this stuff. But what can be itemized, right? So what can go in that group of itemization instead of taking the standard deduction? Well, there's a bunch of things here, but there's really three main ones, and I've grouped them together at the top here. The main ones are going to be your mortgage interest on mortgage amounts up to $750,000. And that means, sometimes I tell people that and they ask me, well, if I have a mortgage amount of $800,000, does that mean I can't deduct any mortgage interest because I have too much of a loan? No, you're going to deduct mortgage interest on the first $750,000 of your loan amount, right? And that's also true, like if you have multiple mortgages, like if you have multiple, like a primary home and a secondary residence, as long as both mortgages are under $750,000, you can deduct both of them. All right. And then on top of that, you can deduct property taxes and state income tax, right? So those are the three main ones. And again, these property tax and the state income tax is grouped together as SALT, okay? The other ones that you can deduct are charitable donations, medical expenses if they're over 7.5% of your adjusted gross income, certain casualty or theft losses, and some investment or business expenses. Most people don't have too much going on in these sections, so it's really the top three. So what's new? So in 2018, SALT, state and local income tax, that section of your itemizations, was capped at a maximum of $10,000, right? So if your state income tax, like the taxes you pay to California, and your property tax, if they were more than $10,000, then you can only deduct the first $10,000, and the rest of it was kind of wasted. But in the new bill, the SALT cap has increased to $40,000, right? So this is a big deal for people in Orange County, because people in Orange County tend to have higher property taxes and higher incomes, right? So their SALT, the amount that they're going to deduct for state income tax and property taxes, in a lot of cases is going to be more than $10,000. All right. So this actually starts for the year 2025. So when you file taxes for next year for the income year in this year, you can already take this increased deduction. Now, it is set to expire in 2029, but that's how things always go when it comes to these types of bills. They kind of kick the can down the road, and then we just hope that it continues in the future. All right, so I just want to go through some examples that I put together. These are kind of based on people or clients that I have, and so these are like sort of real life examples. And I've got 3 of them here. So the first one is going to be for a single person earning $175,000 a year. Their estimated tax rate for California is going to be 7.39%. The reason why that's important is because, remember, SALT includes state and local income tax, so we have to think about what is the California state tax, right? This person also has a home that's assessed at $750,000. They have a mortgage balance of $700,000, and they have an interest rate of 6.25%, which is about the national average right now, okay? So that means that over 12 months, if we look at like the first 12 months of that mortgage, this person is paying about $43,517 in mortgage interest. Okay, so they can deduct that immediately. Like that's already way more than the single person standard deduction of, we said for 2024 is like $14,500, something around there. So just the mortgage interest alone is way more than the standard deduction. On top of this, remember they can deduct property taxes, assuming their home is assessed at about $750,000. Their taxes, given average tax rates in Orange County, is going to be about $7,891 in a year. Their taxes on the $175,000 income at the 7.39% is about $12,932.50. Right? So if we look at this, that means that their full SALT, which is their California income tax and their property taxes together, is about $20,823. And the interest they pay over the 12 months, so it's $43,517. You can combine these two, and the total amount itemized is $64,341, which is a huge improvement over the standard deduction for this person, okay? And if you look at it, their SALT deduction is an extra $10,823. So they're deducting from their income $10,823 more because of this new bill. All right, so that's going to lead into some standard or some pretty serious deductions. If we look at this, let's say, okay, now this person is getting a deduction of $64,341.18. They were getting, let's just round up to $15,000 for the standard deduction. That means homeownership has brought them an additional deduction of $49,341 that they weren't receiving, right? If their IRS, like if their tax bracket at this top end is say 22%, which is likely what it would be in this case, that means they're saving, let's see, a total of $10,855 per year on their federal tax income, right? I'm sorry, their federal tax payments. Also, this person would also be getting a deduction on their California taxes too. The California tax rates, though, are much less than federal, so there's something there, but it's not as significant. That's why I've kind of just focused on the federal. But that means that this person is paying $10,855 less a year in taxes because of home ownership. And remember, a lot of that, or some of that, is due to the increase in the SALT cap. Does anyone have questions on that first example? Does that make sense?
I have a question. So not to go down a rabbit hole, typically I'll just keep digging to try to get more clarity here. But if someone, let's say, does it matter if they upsize? So does it adjust just depending on their property value? So let's say in that year in 2025 or 2026, 2027, they upsize or downsize. It just shifts based on that tax year and gets prorated or something like that?
Yeah, so if they are, they're going to have a statement that shows exactly how much property taxes they paid that year, so they'll be able to deduct that. Now, I don't know exactly the nuance if they switched homes mid-year, if there's some nuance I need to know about, but from how it should be is that they should be able to deduct property taxes from both. And if you think about you're always paying prorated taxes. You're never paying like more tax. So if you sell a home mid-year, you would be refunded for the taxes you paid, if you've already paid taxes that year by the buyer of your home. Does that make sense? Okay, perfect. So this is just example one. This is just a single person. If we look at example two, this is going to be a married couple earning about $230,000 a year. Their effective or estimated tax rate in California on this income would be about 5.3%. they would have in this example, they have a mortgage balance of about $800,000 at 6.25%, same interest rate. Now, it's important to note that this $800,000, this would be capped at $750,000, right? Because remember, the max amount you can write off is up to a mortgage amount of $750,000. Okay, so interest over 12 months in this case about $46,626. Property taxes on a $1 million assessed value is about $10,502. Their income tax on the $230,000 is about $12,190. So if you combine the property tax and the state income tax, which is SALT, you get $22,692, which again is a benefit of $12,692 because the cap was $10,000. Now it's to $40,000. So this is a $12,000 improvement over the cap or the previous cap. If you add up the mortgage interest and all the SALT, their total itemization is about $68,195. Actually pretty close to what it was for the example one, right? So in this case, it'd be a similar amount of savings, about the $10,000, $11,000 per year. All right. Now this third example is a little bit different. This is a married couple earning about $350,000 a year. This person is going to see a much bigger benefit because they're paying a lot more California state income tax. They're really going to test that SALT limit. In fact, in this case, they do, right? So their estimated California tax rate is about 6.96%. They have a mortgage balance of $1.2 million, but again, that is going to be, the benefit is capped at $750,000. So it's the same amount of interest over 12 months in these last two examples. Property taxes in this case on a $1.5 million assessed value is about $15,750. Their California state income tax about $24,360, making their SALT actually a little bit above the $40,000 cap, right? So in this case, I just kept it at $40,000. Oops, $40,000, which is a benefit of $30,000 over what was there before, the $10,000 cap, right? So if we look at it, that means that just from this SALT, like the Big Beautiful Bill alone, $30,000. Let's say they're at a 22% tax base. They're saving an additional $6,600 a year in taxes because of the new bill, right? Because they're able to deduct an extra $30,000. This person has a total itemization of 86,000, or not this person, but this family has a total itemization of 86,626. Right, so that is a huge difference. And if we look at it, let's see here, they were going to get a deduction of about, was it like $25,000 anyway, right? So if we look at a calculator again and say 86,626 minus $25,000, it's a benefit of $61,626 for this married couple to have this home, right? If they're at the they're probably at a higher tax rate, maybe like 24%. So they're saving about almost $15,000 per year in taxes through home ownership. On a monthly basis, it's about $1,200 a month. So it's a pretty big deal for them.
Yeah, it's pretty significant. A question that comes to mind here is, what can someone do with that savings? I know it seems like a simple question, but it's towards the end of the year. But how can someone obviously just save the money and go on some more vacations? Someone can leverage that because they're just like many clients that we all speak to that need another bedroom, or they work from home, or mom or dad's moving in, or kids are staying home because obviously things are getting so expensive. How can someone leverage that into real estate, or just like, what are some top ways would you say off the top of your mind someone can leverage that, or possibly even into additional savings for an investment property for them, built wealth? And that could be leveraging California for out of state, cheaper real estate, or leveraging California. So what are some ways you could do that?
That's a good question. I think that if people realize that they had this extra $1,200 in their budget, then it does open up some opportunities, right? But every person is different. So maybe for some people that means contributing $1,200 a month in extra credit card payoff, right? Or maybe they're really good on debt and they do have some an appetite for some investment, like investment real estate, and maybe they have a lot of equity. In this case, like in this example here, was a 1.2 million with a 1.5 million assessed value. So there's probably not a lot of room to pull money on this one to buy an investment property, but they have some cash, or they have a different equity situation, then absolutely they can look at that, because and depending on where they invest, there might be in a situation where that extra $1,200 makes some investments a little bit easier to do, right? So that's definitely something they can do. Now, one thing I do is, I meet with when I meet with clients, I'm always talking to them, like I'm showing them individually what their tax benefits look like, and I help them budget for that. So like, how are they going to take that tax benefit? That's usually the question that I get asked, which is like, how am I going to see that money? Like, where am I going to get that $1,200 a month? Well, it's really going to come to you in two ways, right? Either you're going to get a bigger tax refund at the end of the year, right? Or you can adjust your withholdings with your employer, assuming you're a W-2 person, and then just get more of your paycheck every other week, right? So there's a couple ways to get that. But I think it's really key to understand this stuff when you're looking at the whole picture, because sometimes people own real estate and they're thinking to themselves, well, man, the mortgage payment's a lot higher than I would pay for rent right now. Does this even make sense? It's like, well, when you look at appreciation and tax benefits and amortization, meaning paying down your loan, just about every single time it's gonna be a way cheaper deal to purchase real estate than to rent a home instead. That makes sense.
Yeah, no, that makes total sense. I mean, I'm even thinking of, even if you were staying long term, you can make adjustments so you can pay down the interest on the loan quicker and pay off the property quicker. So that could be also another way. It could be a way to just, again, put money to the side if it does not get extended by 2029 and something else happens. Because before, and I believe this is true, before there wasn't a cap before this, right? It actually went away, and then now it came back to a certain extent. But before 2018, there wasn't a cap, and it went away, right?
That's true. There wasn't a cap. So, I mean, that's funny that you say that, because it means that this $10,000 cap was a pretty big limitation. And this $40,000 new cap seems like a great deal, but it's actually still not as good as it was before 2018, right? So, I think that these types of things become pretty popular, and it's hard for them to take them away. So we're hoping that they just continue either with this cap or they just remove it again altogether. But it's going to require Congress and politics to make that sort of thing happen. So we'll just have to wait and see.
Yeah.
But generally, people, it's politicians hate to take things away from people. That's generally not a real popular thing to do.
Yeah, we definitely want to go down that rabbit hole.
Exactly.
So okay, so that's awesome. I did have a question here. Brandon sending it in here. So how does it change? How does this change affect lower income families, say around $110,000 range, and with a lower value home? So what would you say to that? And obviously you get more dig into that with Brandon, but what's one of your answers to that?
Definitely, Brandon, I know you well, so I can definitely meet with you and kind of walk you through individually what your situation would look like. But this SALT cap increase is really going to affect people who do pay a lot in property taxes and who do earn maybe more income because they have more to deduct here. So I would look at your individual situation to kind of see where you land. In this first example, this person's earning $175,000, and their benefit above the previous cap was only $10,823, right? So if someone's earning, say, $110,000 a year, if the benefit over the current or the previous cap isn't going to be too big. But that doesn't mean that you're not getting the full benefit, right? Because even if you're not getting any benefit because of the changes in the new big beautiful bill, you're still getting to itemize your deductions, which you weren't doing before you were a homeowner. That makes sense.
Yeah, makes sense. Okay, so that makes sense. Any other questions? And again, okay, here we go. Dakota, you want to read that one?
Sure thing.
And yes, dependent deductions are separate from SALT. I'm sorry, go ahead, Dakota.
No, all good. Kyle, he's coming in with a question saying, are dependent deductions separate from the SALT?
Yes, so dependent deductions have nothing to do with SALT. SALT is literally state and local income tax that you're deducting in addition to your mortgage interest.
Great. Nick is also asking a question. Does having dependents impact this benefit?
No, it doesn't.
Great questions, you guys. Keep them coming.
Yep.
And again, we'll send this out to everyone that's recording. And in addition to that, Byron's link, so you can set up a call with him and he'll dig into it more. Nick has another good question.
Does this change county to county here in California?
I mean, there are some counties that may have different property taxes. So, I mean, this SALT cap increase is a federal increase because what we're talking about right now is the IRS, the federal taxes. So it's going to be the same for everyone all across the country. This change. But the amount of property tax you pay is going to depend on the area that you live in, right? So for us specifically here in Orange County, if you're in Ladera Ranch, for example, you're going to pay a lot more taxes than someone who's living just down the street in Aliso Viejo.
Got it. Great question, Scott. So Scott is asking, is the 40K max regardless of the number of properties owned?
Yes, the 40K max applies to everybody, no matter how many properties you own. And I want to be very clear that the SALT and the itemization, in fact, if you just allow me to go back to that slide right here, like what you put here on line 12 is only going to apply to your primary residence and one second home. It does not apply to any sort of investment properties, right? Investment properties are handled completely differently. They're actually handled more like a business, and you would file your income and losses on that on a separate form called a Schedule E. So that has nothing to do with your taking your standard or itemized deductions. Just to the interest on your primary residence and a second home, on mortgage interest up to $750,000, and property taxes on both.
And some of the things, just to interject on something as well, some of the things that we'll do, and Byron will do specifically, which is awesome, if you're planning on making some type of move in real estate, that you can jump on a call with and do a group call with him, your CPA, bookkeeper, whoever handles your financials, and come up with a strategy so you're able to execute when you want to execute, and you know exactly what to do and what you can't do, what all those numbers look like. So we do that personally when we're like, hey, we see this is coming, we're gonna need more space, we're gonna downsize, or I want to buy an investment property, or whatever that is. You can start planning ahead and make sure you have the right strategy in place as well.
Exactly. Yes, and thank you for that question, Scott. Let's see here. How far out should you be planning? Oh, sorry. Go ahead, Dakota. You want to read the question?
Sure thing. Nick's coming in with another question. How far out should you be planning that?
Was that for Darren?
For me, I would say at least a year. A year and some change. For one, you have two sides of it, right? You have the financial side, but you also have the real estate side of it, of what you're wanting to accomplish. Obviously, we meet with many families who are thinking about moving, and it's interesting because if we know what you're looking for, we might get a phone call tomorrow of someone making that move somewhere else, and it's like, oh, well, Mark reached out to me about what you wanted. You could be a matchmaker. But we can also keep, from a real estate perspective, keep updated with the trends of the market to keep you in line of what's going on. And then in addition to that, Byron can help you plan, especially if you're a business owner or you're getting a raise, of how these things impact you, so you can make the right moves for your family. Because it looks like there's more meat on the bone than what there was before. So maybe you can unlock that and then and leverage it to a certain point that impacts you positively.
Yeah, I'd say that's true. I like to meet with clients at least once a year, like past clients. Typically around fourth quarter is when I start to check in with people to schedule some planning for next year. And what we're looking at, because I think every year any homeowner or someone even thinking about buying a home, they have questions like, should I be thinking about buying an investment property? Can I buy a secondary residence? Should I sell my home and upgrade or downgrade? Should I refinance? Can I get rid of PMI? Like I know every person on this call has thought of those questions at least once per year. So it's always a good idea, in my opinion, to kind of, meet with me at least once a year. If you're more of an investor and own multiple properties, maybe once a quarter, but just to kind of get the lay of the land, look at the options, kind of see what you can do with your current situation, how we can improve it.
Awesome. Thank you for that. Any other questions? Awesome. Okay. So we want to make this short and sweet. Again, we will send you the recording. We'll send you the outline of everything that we discussed today. And we will also be on the lookout for our next one. We'll be launching and letting everyone know within the next week or so what we're going to be discussing for November, whether that's people that are, again, downsizing, different tax changes in tax laws, or just purely real estate, or if you write off, different, give me 1 second here. Just want to make sure there's no other questions. ready to write off different upgrades you make to your home or investment property. So we're coming up with different lines of questions that we get asked all the time. And just, again, making sure that you guys have this information as we have this information, so you can share with your friends, family, coworkers, people from church, mom, dad, and so they're educated and know how to make moves. And so we appreciate everyone for coming in. Again, it's 7:30, so we really appreciate you guys stopping by, and we'll see you guys next time. And look out for your email. We'll send everything over to you, as well as how to connect with Byron, myself, Jerry, Nick, and or Melissa. Thanks, Kyle. Talk to you guys later.
Thank you, everyone.
All right, take care.